Good afternoon and welcome to this afternoon's panel session on managing liquidity in a low or negative interest rate environment. To introduce myself, my name is Jason Macdonald and I lead the Liquidity and Treasury Solutions function at Barclays, and I'm very pleased to be facilitating this afternoon's panel session. And also it's great to see so many attendees at the virtual conference, and I'm sure you'll agree with me that the ACT have done a fantastic job in facilitating this event. Over the course of the next 40-45 minutes, I'll invite the panelists to talk through what they have seen over the course of the last 7 to 8 months, focusing on the initial impact of COVID, what that meant for liquidity, and then the evolving trends that we saw over this same time period across the broader market space. We'll then look to move the conversation into a forward-looking view, how liquidity management may be impacted further, and the further changes that we might see as a result of a low and in some cases negative interest rate environment that we are operating in today and will most likely continue to do so for some time. I'm very pleased this afternoon to be joined by a panel of 4 liquidity experts, and in a moment I will obviously ask them all to introduce themselves and then go into the questions. But before I do, I just wanted to spend a moment setting the scene for what it is that we're about to cover. And of course, in addition to my questions, the Q&A functionality is available. I'll do my best to monitor those questions as we go through the session, but please do interact. And that way I can try and ensure that we get the most out of the session for you as the audience. So 2020 has not been the year that any of us had planned, whether that be from a personal perspective or even a business perspective. And when the financial implications of COVID and the pandemic took hold of the industry materially in March, the market saw a rush for liquidity. Treasurers such as yourselves drew on sources that you probably hadn't intended to do so. Central banks moved mountains to shore up their own individual and respective home markets, and banks needed to react to client demand, more likely lending and then holding more liquidity than would have been forecasted in any annual planning cycle. Businesses have been materially impacted in a number of ways over the recent months. The changes that we have seen, and importantly the changes that we have implemented, may even be a catalyst for a new normal. And from a liquidity perspective, that may mean new Treasury policies. It may mean that IT projects finally become funded, they make their way up the priority list and visibility is improved. Or it may even mean a total rethink of how our bank accounts are set up, and the reporting that goes hand in hand with that. But when we talk about liquidity management, the one thing that has been reconfirmed is how important liquidity is, and therefore getting the basics right is so fundamentally important for our businesses. So to the speakers, I'm now going to ask them to introduce themselves, and we'll start with Yera, please.
Hello everyone, I'm Yera Hagopian. I'm responsible for liquidity product at Barclays Corporate Bank. Eric, I'll pass over to you.
Yeah, hi, thanks Yera. My name is Eric Pinn. I'm responsible for investments at Barclays Private Bank, as well as our collaboration with our corporate bank in providing the off-balance sheet capability. I will pass it over to Andrew.
Thanks, Eric, and good afternoon, everyone. My name's Andy Alabaster, and I'm at BlackRock Investment Management, and I'm responsible for our bank and insurance distribution for the cash management team. And Alain, pardon me.
That's fine. I'm Alain Stangroome. I'm Global Head of Liquidity for Legal and General.
Great, Alain, thank you very much. So I'm sure you'll all agree that we've got a fantastic panel of speakers here. So on to the questions, and I'll promise to be as nice as I can. Yera, I'm going to start with you, if that's okay. Could you, and it's quite a broad question to get everybody's minds and thoughts kind of where we need them to be. So would you mind giving us your thoughts on how the pandemic has impacted liquidity?
Yes, thank you, Jason. You know, you've just reminded me what a long time ago March actually feels in this extraordinary year that we've been living through. But I think we do need to start by reminding ourselves that this was not a financial crisis at the outset. Many people compare it to 2007 and 2008, but that was fundamentally different. What was very clear from the outset, though, was that there was going to be some deep financial ramification for the entire world. And I think the thing that's been the most worrying of all is just the sheer level of uncertainty that we've all had to grapple with this year. Not just the uncertainty of the disease and how it would evolve, and how it would spread, but also how governments would respond, obviously. And you know, it's understandable, and that people were worried, and you know, you described the way in which people reacted, and it was justified. Next to nothing was known about COVID, and as we've seen, next to nothing was predictable about the responses that it would generate. So it's not really surprising that companies and institutions around the world took action to secure their future. And as with every unsettling situation that any of us have encountered in our careers managing liquidity, I think, you know, it is the first thing that people reach for when their survival is threatened. And the first reaction, as you said, was we saw people drawing down on liquidity, on all their available lines of credit, regardless of whether the funds were needed or not, and just to make sure that they had them available at short notice. And you know, from the banking side, what we saw was that there was a real aversion to term structures. People wanted the money to be available. They didn't know what was going to come next. Larger companies who could access capital markets, obviously, they did so as well. And you know, the net outcome of all of this was there was quite a squeeze, a liquidity squeeze, and that, of course, that sent cash prices, you know, sky high at the same time. That sort of was the you know, Act One, really, if you like. An awful lot's happened since then after that initial response. Very soon after that, as you will all recall, governments in many countries responded with a whole cocktail of measures: central bank rate cuts, quantitative easing measures designed to pump ample amounts of liquidity into the market. And here in the UK and elsewhere, we've also seen the launch of many government schemes to help both businesses and individuals to support the economy through this very difficult time. Finally, the nature and impact of the virus has become a little clearer. I'm only going to say a little, partly because I really don't know very much about medicine, but also because it's very clear that there is still an awful lot which is unknown about the virus. Of course, you know, there are daily reports of a vaccine, but also conflicting reports of when they'll be available. And then there's the challenge of distribution. So the future is a little bit clearer, but it's not really so very, very much clearer than it was. So people are still living with a very high level of uncertainty. And in some ways, you know, the uncertainty and the pain have just been pushed a little bit further down the road. I'm not going to talk any further about the virus. As I said, that my medical knowledge is very, very limited, and I think I've provided all that I can on that topic. But it is a relevant point, because it is the uncertainty of the medical outlook which is, you know, the source of the main issues that we all face right now. It's been impossible to plan in this environment, and I don't know about anybody else, but you know, certainly in my business, what we were planning for this year and what's actually happened have been two very, very different things. And I think if we were in a room right now and I asked everybody to put up their hand to see who had been able to stay true to their original plan at the onset of the year, I think there'd be very, very few hands up right now. So I'd be interested to hear your views on that when we get to the Q&A, as to, you know, how deep the impact has been and how easily you've been able to adjust to the circumstances that we faced. So anyway, coming back to the situation that we now find ourselves in, the supply of external liquidity has increased dramatically, and people are still holding very, very high levels of liquidity. The governments are continuing to support the markets, and we have a situation also at the same time where rates are at unprecedented low levels, and with, you know, quite a lot of talk that potentially they could go even lower, possibly even negative. And this presents a few dilemmas of its own, to be honest with you, because, you know, holding surplus liquidity is the obvious safest option, and it is understandable that people want to do that, but it comes at a price. And the issue of yield is exacerbated by the high level of risk aversion that people have in this environment. Ultimately, what we're saying is that the safety net will depress returns for most businesses. And ultimately, there will come a point when shareholders will start to ask questions. So I think that those are some of the challenges that we now face. And it's a little bit of scene setting, I hope, to the rest of the discussion. A bit of a long answer, I'm afraid, Jason, but it was, as you said, quite a big question.
It was, Yera, and thank you. I think there's some really interesting points there. And again, if bringing this into the liquidity management piece, I think some of the concepts that we're all familiar with who work in the liquidity business is the principles of security, liquidity, and yield. And from what you said there, it certainly seems in that immediate aftermath or kickstart of the pandemic, liquidity was really important. And then security becomes more important. And then, in this environment that we're in now is, yield probably isn't that important. But even if it was, I think we're in a relatively low market, which could make that difficult to obtain. So, Andy, I'm going to come to you now, if you don't mind. Obviously, a little bit of a different perspective, and from a money market and a money market fund perspective, how did the impact manifest itself across what you saw?
Thanks, Jason, and good afternoon, everyone. Again, I mean, I think I'd agree with what Yera was saying. Well, everything that Yera said, actually. But we're talking about the impact on money market funds. It is worth bearing in mind that this wasn't a financial crisis, but the impact on money market funds was acute, both from the standpoint of client behaviour and also in terms of the portfolio management side of the of money market funds. So, first and foremost, and one of the things that's been probably most documented is the impact on flows in money market funds. And in March, this was particularly acute as we saw, in some cases, quite sharp outflows from money market funds, especially in the latter half of March. From our perspective, this has been a little bit, in some commentators, though, of fighting the last war, i.e. the GFC of 2008, where people have viewed that as a problem in and of money market funds itself. In our view, actually, and again echoing Yera, it was more a case that, or at least what we saw from our client base, were people drawing liquidity from wherever the most liquid standpoint was. We saw quite sharp dips across the industry in terms of money market fund holdings, in late March. But that was preceded by an increase in money market fund holdings across the industry in the run up to the lockdown periods, and then across the late spring, early summer, and beyond. Actually, we're now in a period where European domiciled money market funds are at or very close to all-time highs in AUM. I think that does mask, though, a little bit of deviation or difference in between the main currencies of money market funds in EMEA, and perhaps the experience and appetite for dollar investments, dollar investors, into money market funds was a little bit different than both euros and sterling money market investors, where we saw flows in US dollars being more dramatic, and also Treasury or public debt money market funds picking up a lot more AUM in the back end of March, or picking up a lot more assets from cash investors in the back end of March. But as we rolled through the summer, we saw, as people drew down on credit facilities and other facilities, or raised liquidity in other means, that we've seen quite a sharp increase in money market assets as an industry, despite the fact that yields have continued to ebb ever lower. And obviously the negative rate discussion is something that is, if not even our base case, is certainly something that we can't ignore as money market investors, or indeed as cash investors generally.
Thank you, Andy. And, obviously lots of comments there that resonate with what Yera was alluding to at the start, and certainly with you getting to near almost record highs. I think your comments were around investments into money market funds. That supply of liquidity is so evident from all types of investment solutions. Alan, I'd like to turn to you now, please, as your role of global head of liquidity. It'd be really interesting to get your perception and obviously using a number of solutions for liquidity management. Be interested to see what has been the impact of your business through the pandemic.
Okay. So first up to say that as an insurance company with a lot of life insurance in our business, we're exposed to pandemic risk. So it's one of the things that we model and we manage to. And in our way of managing this, we've always presumed that a pandemic, if it hit, could impact a market as well. Not that it would, but that it could. So our prudent way of looking at this is to say they're both going to happen and they're both going to be bad, and therefore we should manage our liquidity. So fortunately, going into this crisis, we had liquidity in the right places. We'd built it up in the right places and contingent liquidity to manage these risks. So we were, I wouldn't say complacent, but we were well positioned. What we found through the crisis is the thing that impacted my team most immediately was a very quick and rapid increase in required management information. So we have management information around liquidity. The speed and the requirement for it rapidly increased, and we were reporting information on a daily basis that we typically would report on a monthly basis. And so we had to build processes around that to gather the information, check the information, et cetera, et cetera. It became quite a sort of pocket industry, if you like, of managing that. The other thing that was noticeable within the company, as to what Andy was talking about, is that within Legal and General, we have large money market funds and large other collectives as well. And so the managers within those funds were actively looking at performance of their customer base, how to position liquidity so in anticipation of potential withdrawals. Obviously, we had some gating imposed by regulators in terms of real asset funds, and so we had to be cognizant of that as well. So there was a communication piece as well around that the business had to be aware of. But as regards sort of access to liquidity facilities or changing in liquidity facilities, we didn't need to make any material changes from where we were because we were well positioned coming in. And obviously, now that things have placated a bit, we still feel quite comfortable on that position.
So it certainly sounds that you saw the impact across multiple market spaces than Alan, with respect to, as you mentioned, your own money market fund as well. I mean, in terms of the reporting piece, I'd actually like to come back to that point as at a later part during the conversation. But I know when we were speaking last week, some of the markets that you referenced that you invest in. Have any of those markets been impacted by central banks? And have you been surprised about the way that different central banks have reacted to different investment and sources of liquidity?
Well, obviously, the central banks providing liquidity, entering into quantitative easing, have depressed yields in lots of different markets, compressed spreads, et cetera, et cetera. And that complicates the process of managing long-term asset portfolios for life insurance. So it's made it complicated for my colleagues trying to build those asset portfolios. It hasn't stopped the core business of pension risk transfer. So we continue to take on new pension business. We continue to buy assets to support that. That activity is ongoing, but it has made it more challenging. I mean, the key sort of thing that was a little bit of a bugbear coming into the crisis is that although we had central bank support and we had good support from the Bank of England, and as mentioned, the government has stepped in to support how the economy is working in the UK. It was quite frustrating that when the central bank in the UK enacted a process whereby they buy commercial paper within the market, they exclusively restricted that to corporate commercial paper. Whereas when we look to the Fed, we can see them active in financial institution commercial paper, including insurance. Not a complicating thing for Legal in General, but it obviously distorts the market in a different way from the way that it was in the Fed. And I think if I was complaining to the Bank of England, that's something that I would definitely complain about.
Yeah, of course, and Andy, sorry, Alan, that's really useful, and it came up, similar to to what you mentioned there around that different stance from central banks. Certainly, I know that's something that's come up in conversation with Eric and I. And Eric, I think at this point it'd be useful to get your thoughts. Really, obviously looking at a broad range of solutions, that are not typical kind of bank on balance sheet deposits, and working across a lot of different markets within your role at Barclays. What have you seen from a trend perspective, but also a rate perspective?
Yeah, thanks, Jason. And I think it comes back to a point actually you started with, right? It's a balance of that security, yield, and liquidity. And Alain makes a good point too, right? Particularly regarding commercial paper. It was Bank of England and the ECB actually put in restrictions that the Fed didn't. And at the same time, with low rates, companies actually not issuing CP, they're actually issuing for longer and lower than they were when they were using CP to pay bills, because most CP commercial paper has been issued to pay bills, usually with a maturity of 30 to 60 days. That there's being a recalibration of the market between supply and demand for commercial paper, both for issuers, corporates not seeing actually a need to issue commercial paper, as well as actually now buyers. A lot of the money market funds, particularly prime money market funds, LV NAV in Europe, are not going to be big buyers of it because you're not being paid to hold commercial paper relative to a govie. The gap, it used to be in 2019, there was a gap of 43 basis points between a 3-month T-bill and 90-day non-financial commercial paper. That gap today is 10. So you're not being paid to hold commercial paper like you were in the past. So like I said, that recalibration of commercial paper, what I'm trying to say is there's a lot less tools available today. Commercial paper is not as readily available. The big piece though too is because rates have brought everything down without a doubt, and everybody knows it. But the other part that we're not talking about is liquidity. And liquidity is not as plentiful as it was in the past. We had a client this morning who was looking to buy just 30 million pounds of gilts and struggled to get filled. And this happens repeatedly every day where that liquidity is just not there. Money market funds actually have a place to play there, because if you can't buy the T-bills or the gilts, then actually you're going to put into the money market fund. Your return is pretty much the same. You have more diversification and a bit more in the same security, and you have liquidity. So I think those government-backed, not government-backed, sorry, wrong word. Those money market funds that are largely investing in government bonds really will have a larger place to play. Those money market funds that were, let's call it, had a large allocation to commercial paper are not attractive today because you're not being paid for the risk. And there's some asset managers that are starting to close them and convert them into government money market funds that hold only government securities. And then you have obviously the T-bills and the gilt market, where you have to go out and take duration before you're actually really starting to be paid yield. So you really have to decide, like I said at the beginning, between security, yield, and kind of liquidity. And part of security also is duration risk and how long you're willing to go out. I think at the end of the day, what that does though is it makes a lot of people have to rethink their Treasury policy and what tools they make available to them, what tools they make available and feel comfortable using.
Yeah, very, very, very good points there, Eric. And I think that kind of balance between security and liquidity and yield is one that will probably no doubt continue to stay in the minds of most, as not just through this period, but in kind of liquidity management more broadly. I'm just going to jump onto 2 questions we've actually had that have come through the Q&A, and then we'll kind of look towards the future. So again, this is quite a broad question, so actually happy for any one of the panelists to jump in here. So it's question, so for low and particularly negative interest rates put banks' balance sheets under major pressure. Low and again particularly negative interest rates also mask any signals relating to counterparty risk. What additional steps should treasurers take when seeking to measure counterparty risk? prior to investing short-term cash during periods of low and or negative interest rates? So quite a long question there, but just to recap, what additional steps should treasurers take when seeking to measure counterparty risk prior to investing short-term cash during periods of low or negative rates? Yeah, potentially one that I might come to you on that, just for a thought of from a bank's perspective, what have you seen clients do in the past?
I think firstly the first part of that question, the statement obviously is very valid. It does put a lot of pressure on banks' balance sheets when you're operating in a low rate environment. I mean, one of the primary functions of a bank is still to take deposits and lend money, but the margin between those two things comes under extreme pressure in a low rate environment. I think from my perspective, though, in terms of looking at risk and reward, I think the two things almost have to be considered independently. People have to do their risk evaluation first, really. They have to look at the risk that they're prepared to take. And this comes back to something that you mentioned at the beginning of the discussion, Jason, which is around, the investment policies, the Treasury policies that a company has. I mean, those probably do need to be revised and reviewed at a time like this, because they may just be too narrow and they may not be operable. But fundamentally, the risk has to be acceptable. That may have return consequences. Obviously, every company will view its portfolio in a different way. And we have to remember that our clients will be in very different situations. Some of them will have a lot of cash to invest, more flexibility in terms of how they manage their portfolios. Some of them will have less cash. The cash will be required for working capital purposes. They won't have that luxury to be able to play with, say, longer dated investments, etc. So it is it's something that's very specific to the client, I think. But fundamentally, I think risk has to be assessed first before any discussions about yields can begin.
Thank you, Yera. Really, really insightful comments there. Okay, so Alain, I'm just gonna come to you now as we start to move the conversation into, what does the future potentially look like? And obviously, none of us have a crystal ball. I think we'd all quite like one at this minute in time. But from an L&G perspective, do you think that any of your priorities, whether they be short or medium-term priorities, do you see any of those changing, and any challenges that you see to achieving those objectives?
Okay. I think the first challenge that we see or we consider is what happens when central bank support is withdrawn. How is it withdrawn, and what happens to the market when it is withdrawn? And until it is withdrawn, we feel a little bit uncomfortable about the clearing levels for a lot of assets, because they're really not finding the right price at which they should trade, but you still have to play. And so there's some concern about what the disturbance will be to the market when central bank support is withdrawn from the market. So alongside that, we as a company are keen to be investing in not least the UK economy as it grows and as it makes a transition through this COVID crisis. But the other thing that we're concerned about is, how this ongoing economic crisis plays out through corporate credits, credit deterioration, and deterioration of some of the assets that we hold. So that's a sort of twin concern. And then if I want to add a third concern into my space, we have a business that's very active in developing direct assets, direct investment assets, and very active in development space in the UK in a number of different fields. And that's been a challenging environment, not least in the first stages of the crisis when we had to stop building lots of things. But even as we play that crisis through, changes in the value of real estate assets will change values of other assets that are in that portfolio. So, lots of challenges that we see from here, some opportunities, but I think still quite a lot of challenges that we can see.
Yeah, great. Thank you. Thank you very much. Andy, I think we've all mentioned through kind of the last half an hour that there are lots of security and liquidity are vitally important. Yield is obviously something that does remain a factor, but low interest rates they're not new, and actually they're seemingly becoming quite cyclical in their appearance. So coupled with large cash pools and the need to lead to diversification, what are you seeing from a money market fund perspective, and what would your kind of view be on ways to look at yield?
Thanks, Jason. We may need a couple of hours to delve into that and do it justice, but I'll try and do an abridged summary. So I think there's a couple of things that have already been said actually that are quite pertinent. I mean, firstly, when you're looking at money market investment, you are looking primarily at liquidity, security, liquidity, and probably yield in that order. But it's not to say that yield isn't an important consideration, but it's perhaps a tertiary one, at least the way that we think about money market investment. But we are looking at a low yield environment for the foreseeable future. I mean, in euros, obviously, we've been in a relatively deep negative environment for 5 or 6 years, depending on whether you're looking at money market investments or the actual deposit facility for the ECB. But the current curves across the three major currencies are incredibly shallow, as Alain and Eric were saying. I mean, I think if you're looking at the CP curve, the commercial paper curve, in terms of the sort of the top tier commercial paper curve that we look at, you're in a range of somewhere close to zero in the very short 1 to 3 month, out to only maybe 10 basis points in the 12 in for 1 year commercial paper. That makes actually investment in commercial paper relatively unattractive for money market funds, as Eric was saying, and that will continue to depress yields even further. Whether we actually see negative yields in sterling or indeed dollar money market funds is something that at the moment, if we're going to probably sit on the fence a little bit, but it's probably not our base case as a house. But nonetheless, you are looking at material risks in terms of negative rates from a more systemic standpoint. So at that point, you're really looking at why would you be using overnight or short-term liquidity vehicles, money market funds and others. And in our view, is actually potentially something that's going to come more into play. If we look at it from our investor base, so outside of the corporate treasury and mainstay users of money market funds, we're arguably seeing, and this is something that our own CAO, Larry Fink, argued last week, something sort of an ultra barbell approach in terms of you're not getting much in terms of yield or return in investing in traditional asset classes as an investor. So, but you still need the liquidity. You still need to hold it for margin purposes. There's whole discussions around whether or not clearing and the use of money market funds and other instruments for cleared and uncleared margin requirements might become more something that becomes more to the fore in the market. So liquidity requirements on one hand are increasing, especially with the incredible uncertainty that we're all facing, COVID, Brexit, the US election, everything else. But at the same time, in order to actually gain returns as an investor, perhaps you're looking further out the curve, or as Alain was saying, into the real assets market. So we actually see the need for liquidity and security increasing. That doesn't help you very much if short-term liquidity is your overarching investment goal. But the way we're looking at it is that we're providing that liquidity and security, as are others, and there's other top tier money market instruments and securities. But actually, the way in which we're doing it is changing, and the provision of that liquidity is changing. So we are migrating at the moment more to sovereign and agency paper within our portfolios, because there is no credits, there is no spread, or what spread there is, it isn't worth it. There is very little appetite in terms of adding duration into money market portfolios at the moment, generally speaking, because the levels don't pay you to do so. I mean, I think it was Alain was talking, and Eric were talking about commercial paper levels, but actually in terms of levels of issuance, but even in the sovereign space, we're actually seeing a reduction in bill issuance as well. And the UK bill market has, auctions have been marginally negative too. And that bill issuance is also part and parcel of the fact that if you're the French sovereign or the German sovereign, you're probably better served in terming out. So that liquidity provision and expertise is going to become more important. That yield is going to be more difficult to come by, however, but we think actually counterintuitively that the need and demand for those sort of products and vehicles is only going to increase rather than the other way around.
Great, thank you. That's very comprehensive. Yeah, no, it did. Thank you. It's there's a lot to take in all of these answers, and I think it just goes to show that how how the environment that we're in is actually it's a really difficult time actually for the management of liquidity, and certainly all of these kind of the questions and the answers are pointing to that. Um, Eric, I'm gonna come to you. Off the back of what Andy has just said, and that kind of battle between is now now not probably being the right term to add duration into a portfolio. Through your broad conversations that you're having with clients at the moment, what are you seeing and what's really topical for you in those conversations?
It's a great question. First is I want to actually come up back on something you said, Jason, which is actually we've never seen rates this low. Outside of Japan, in dollar, euro, and pound, we have not seen. You bring it up on Bloomberg. You go as far as you can on Bloomberg to 1954, and rates were higher than they are today. Okay, so people are, and you don't like to use the word unprecedented because it's overused. But you know what? None of us, even with the gray hair, have ever seen this. Okay, so it is all new territory, and that is the reality. Okay, in boons. Okay, right? You pay -57 for 1 year bond, negative 19 bips for a 10-year bond. Not until you get to 16 years duration do you get positive. Okay, so you can take duration, but nobody's going to take 16-year duration to just get positive and break even. So at the end of the day, what are you going to do? I think it comes back to actually what Andy said was you're still going to have a lot of use of these products because actually they provide liquidity and they provide security. We are seeing some people start to think a little differently. It is, you said, you got to take risk. Taking high quality credit risk is actively and having it actively managed is an option for those that can do that, right? And there's a lot of people, though, particularly in the corporate world and in the Treasury world, that can't do that. But there are some people that are starting to do that. That's where you can actually start to, with a decent, not a really long duration, 3 to 4 year duration, you can actually start to make some yield. There's other products available too that tend to be either capital protected or FRNs from banks that actually provide an arbitrage on an underlying derivative, but that also doesn't sit really well with a lot of corporate treasurers and policies, right? And understandably, right? I'm not advocating it, but so there are some places that you can start to see some of that yield. It really depends on what liquidity you need. Do you need access to that money? How do you look at risk? And then are you being paid for it? And so there's not a lot of options unless you really start to look at taking more credit risk because the duration you're not being paid enough for, quite frankly, as Andy said. But you got to start to take credit risk. And if you can actually don't require the liquidity, then there are ways of looking at some other assets, and they're both real assets as well as other assets when you go further out. But that tends to be more into the private client side with family offices. It's not on the corporate side. So what we're seeing is, I guess to answer your question, Jason, is I still see people surprised by where the market is regarding yields. And that's what surprises me. Not somebody like Alain, he's been living with it intimately and knows it inside out. But I think that there's other people, particularly not in financial services or in finance, where they have not reset their thinking to understand that we're in a world that we have not seen, and it is going to be here probably for a prolonged period of time.
Great, thank you, Eric. And I think some of the comments you've made there around, Treasury policies, ensuring that counterparty risk is appropriately managed as well, and that balance of tenor is actually really important. But I know, again, through conversations that I've had with corporates over the recent months, that Treasury policy and needing to refresh that policy, make sure that it still stands the test of what are strange times and to your point, kind of the lowest rates that we've seen across some puts and obviously these currencies, Treasury policy is vitally important at this minute in time.
But Jason, I wanted to add to that though, right? Is because you are right, you're spot on the Treasury policy, but there's a reality too, which is, you know what? There may not be a large risk appetite, and which is understandable. So maybe that actually starts to mean that how people look at their liquidity, they start to possibly look at differently. And maybe possibly not holding as much liquidity, trying to match more liabilities and payables and receivables to try to better balance it. But then there is another reality too, which is, okay, fine, if I need to actually only use gilts and T-bills, that's the rate I'm going to earn. So I need to factor that into my business and the overall P&L of my business, which means actually I may need more out of another part of my business to actually generate that return for the shareholder. And so that actually, that the impact of the market on a Treasury policy that maybe cannot evolve actually has to be factored into the company's P&L. And that may require actually different decisions from a business perspective that people are going to have to look at, because we can only lower our fees so much. We want to help, but at the same time, we need to make money. BlackRock needs to make money. LNG with their money market funds, needs to make money, because if we don't, we're not here tomorrow for you either. And so it's not available free. Everybody actually needs to make money on it, so it's robust and is a viable product for you tomorrow. So there is a reality, though, that the yield is actually may not be that attractive and may not be what it was in the past, and that has to be factored into the cost of business.
Understood. Very clear. And just very conscious of time, I think we're approaching the last 2.5 minutes of the session. So Yera, just one more question for you, if I may. We've heard a lot about the low interest rate environment and that need to balance liquidity and security at this minute in time. So how can banks help corporates with liquidity management in this low environment, and do they need to do anything differently?
Well, I think banks have the benefit that they're engaged in the entire end-to-end of their clients' working capital cycle, and I think we shouldn't look at liquidity management from a very narrow perspective. Liquidity management starts, when companies are raising capital. That it starts when companies are funding their payables and receivables through trade finance services. And I think one of the things that struck me the most about this crisis is how, through it all, our clients have been able to work from home and run their businesses from their living room. And that in part is due to the way in which bank services have evolved. They have become very heavily digital. Now, that was happening before the crisis, and no doubt the crisis will continue to push banks to invest in their digital services. But I think that is one huge contribution that the financial services sector can make and continues to make. I think the other thing that is prompted by the discussion we've just had is just the range of services that clients need. They will need to look at diversification. Some of the options that they've used in the past may be more limited. Banks have often the capability to provide those broader services, and I'm going to criticize us a little bit here now, but maybe sometimes we're a little siloed, and maybe we don't work together to deliver all those services in the most sort of streamlined way to our clients. So I think there will be more pressure on banks to work more collaboratively to deliver that sort of end-to-end, cash flow management, cash flow support throughout the whole cash flow life cycle of a business. And then I think finally, something not to be underestimated, this crisis has shown how important liquidity is, and often the best source of liquidity is actually within the company's own remit. It's those pooling and cash concentration services, they need to be reviewed regularly. Are you making the most of your own liquidity? And I'm going to stop, Jason, because I can see that we're rapidly running out of time.
Yera, thank you very much. And in the last 20 seconds, I just want to say thank you to everyone who's joined me on the panel this afternoon, and thank you to everyone for listening. I hope you found it informative. If you do have questions, then please do come and visit us at the Barclays stand. And once again, thank you and enjoy the rest of your afternoon. Panelists, once again, thank you very much.